Good afternoon, everyone. My name is Kiran Karande, and I'm the Associate Dean in the Strome College of Business. Today is the first Strome Insights webinar of Spring 2024, and it's going to be presented by Andrew Cohen. The title of his webinar is Investing in ETFs to Achieve Your Investment Goals. Andrew is one of our star instructors. He's won all kinds of awards. He's been the distinguished teacher at the university. He's won the teaching award in the college. He's even won the most innovative teacher at the Financial Management Association, which is an international organization of finance instructors. So he is a great instructor. On top of that, he's very creative. So, he is, for example, he's created the Future Traders game. And if you've not tried it, try it out. It's fantastic. He's also a strategist. He is a strategist, investment strategist for Validia Capital, where he helps out in strategizing about growth and value models. Andrew started his career at Goldman Sachs, and before that, he's worked for several years, tens of years on Wall Street, and before that, he got his MBA at NYU. So that's briefly about Andrew. Many of you already know him, so I don't need to talk more. But before I hand it over, he will maybe present for about 30 minutes, plus or minus. And after that, we will open it up for questions. So if you have questions, please use the time to ask him those questions, and he'll, of course, give us fantastic answers. So I'm really looking forward to this webinar. Andrew, thank you so much for doing it today. Andrew is not feeling particularly well today, but he just wanted to do it. And I hope he'll be able to survive the next 1 hour. And so it's all yours, Andrew.
Thank you, Kira. Thanks for the great introduction, and welcome, everyone. So one of the reasons I want to talk about ETFs is because it's really one of the great financial innovations for basically democratizing investing. It makes investing so simple for anyone, particularly for individual investors, to get the benefits of diversification, simplicity, transparency, and tax efficiency, as I'm going to go over in a moment. And really, as far as helping out the small investor, there's been two amazing financial innovations in the last 50 years. The first was by Vanguard in the mid-1970s. So Jack Bogle, the founder, started introducing index funds where he would basically follow the market. He believed in the efficient market hypothesis and let investors invest very cheaply, very low expense ratio, and kind of capture the whole market without having to pay a lot of fees for fund managers. And ETFs were the next step, which are even a step better, we would say, than what Vanguard did, because it takes the best of basically fund diversification from funds and also the flexibility, transparency of a stock. So let me go over the basics. And a lot of this, though, is going to be, I want to give you real practical advice. I'm going to show you different ETFs that you can invest in. So the purpose of this is to educate you, but also give you some really great practical tips on investing. All right, so I'm going to cover what is an ETF, how and why they were created, why they are an amazing financial innovation. We'll look at the advantages, and then I'm going to go over specific ETFs you can use to enhance your investment strategy and how you can customize exposure to any geographic, sector, product, et cetera, that you can do. So, ETFs are very flexible to do a lot with. And so first off, the simple way of thinking of an ETF is think of it as this big wrapper, okay? And it's a big wrapper, and you can put anything in it. For example, there's an ETF on gold, ticker GLD. The first ETF on bonds was LQD. And, there's now ETFs on cryptocurrencies. There's ETFs on almost anything you can imagine because it's put in a wrapper. I'm going to mostly focus on equity ETFs, stock ETFs. And I'm going to start with going over the core basic ones I think everyone could use in their portfolio, and then I'll go over a little more of the esoteric ones and some of the thematic ones, all right? And the big advantage, again, of an ETF, is I can't reiterate this enough, I'm going to repeat myself, is that you could buy an ETF giving you exposure to multiple companies with one click of the button. You go on your account, you can just buy an ETF, and with one click, you get exposure to 500, 3,000, 5,000 companies in one click with very low expense ratios. All right. You could buy and sell it on exchange just like a stock. If you could buy it in the morning, sell it in the afternoon if you want. All right. It's always liquid. You can buy and sell it anytime. And, the idea is that it combines two great investment ideas together: the flexibility of trading a stock and the diversification of a mutual fund with much lower expense ratios and more tax efficiency, as we'll see in a moment. All right. Again, we know what a stock is, right? We can trade throughout the day. You can also do that with an ETF. There's a bid and ask. You trade at any time of the day. And with an ETF, you also can get the benefit of what a mutual fund has: a diversified mix of securities. And we'll see there are passive ETFs where you just follow an index, and there are active ETFs and even so-called smart beta or quant ETFs, where they're trying to combine the benefits of a smart fund manager to try to beat the market with the transparency and tax efficiency of an ETF. So again, they are listed like a stock. They trade on major exchanges globally. And with an index fund, and I'm going to talk about index funds in a moment when Vanguard introduced them, and how that was a great breakthrough and why ETFs were even better. So they kind of combine the advantages of an index fund with the single stock. And you could short an ETF. There's options on ETFs. They give you real-time pricing, and you could do a lot of different trading strategies on it. All right. Now, let's talk about the brief history of an ETF. And I don't know if you know this, but most fund managers underperform the market. All right. And so before 1975, no one really knew that. We didn't have supercomputers. And so a lot of people, the one choice to get diversification was to give your money to a fund manager who would then hopefully, if he was smart or she was smart, buy stocks that hopefully were good stocks to try to perform as well or better than the market. And it made sense, right? These people are professionals. They should beat the market. Well, it turns out once they started looking at the data, that didn't happen, that people were paying high expense ratios for underperformance. So I'm going to give my first poll. So Karen, if you could distribute the first poll, the question is, what percent of large cap fund managers have beaten the S&P 500 say over the last 15 years?
Can you see the poll?
Yes. Yeah, these results are coming in right now.
Yes.
Good.
Okay.
Okay, great. So we'll end the poll. Okay. So the majority thought that 7% of it looks like 40%. No, I'm sorry. Let's see. 57% picked 7% of the fund managers beat the market. Wow, you're more pessimistic than the real world. So it turns out that 12% of fund managers have beaten the market over the last 15 years. So 88% of fund managers charge you more money and don't beat the market, right? Not a great one. So if we look at the numbers here, I'm just going to share, I'll share the results, and I'll go into, let me exit out of this poll. Okay. So if you look at the fund manager, and again, this is the United States large cap funds, okay? Almost 88% of funds underperform the S&P 500 over the last 15 years. If we look at the last 10 years, the number doesn't even change that much. 5 years, it's still at 78%. And if we look at other fund categories, all right, we can see that no matter which fund, whether it's large cap, mid cap, small cap, domestic, international, the 15-year period is pretty steady at close to between 85 and 90%. Actually here, large cap core, 95% failed to beat the market. So only a little over 5% beat that. So I'm making this point, going back to my slide, is because basically this is why Vanguard became successful. Vanguard said, look, if most fund managers are charging 2 or 3%, and most of them are failing to beat the market, why not just create a fund that matches the market and let small investors put as little money as they want in the fund and only charge them about 30 basis points, or about 0.3% initially, about 1975. It eventually went lower and lower. So this was the first big breakthrough where small investors could invest a small amount of money, do dollar cost averaging, any strategy they want, and invest in the market without paying high fees and having really almost minimized or almost gotten rid of individual stock risk. So they just have market risk. And the S&P 500 in the long run has gone up about 11% a year over the last 50 to 70 years. So if you can get 11% per year, that would be great, right? You're certainly doing a lot better than bonds and having your money in this in a CD or in a bank, okay? So that was the first big breakthrough. Now, after the 1987 market crash, you had a lot of market participants trying to analyze what happened and why did the market crash and look at the makeup of the market. And with that, they decided to create. Now, one of the disadvantages, by the way, of an exchange traded fund that Vanguard had was a couple of things. One, you can't trade it during the day. You can only, it's redeemed at the end of the day. And it's not that tax efficient. In other words, as they buy and sell stocks to rebalance, they have a tax event. So if they have a gain in a stock, you as the fund holder will pay taxes. So 1993 was the big breakthrough. And that's when the first big monster stock ETF was created. And it was created basically to compete with Vanguard's 500 index. And they gave it a 0.2% expense ratio. Okay, so 0.2% expense ratio, if you think about it, if you invested $100,000, you're paying $200 a year. If you invest $10,000, you're only paying basically $20 a year. So it was very low, about 1/10 or 1/5 of what a lot of other funds were charging. And this was traded daily, and it had an advantage of being tax efficient because when at first they didn't even when they created this, they weren't expecting it, but because without getting to the tax implications, it was called trading securities in kind because they were just transferring the securities. They didn't have to pay taxes. So if you buy an ETF like SPY, right, and Vanguard or wherever fund that's using it, or State Street, or the iShares, whichever one, and they were balancing, there's no tax implication. You don't pay any taxes. You only pay taxes on the dividends and if you sell it, right? So that's another big edge. So with that, let's talk about why they're so popular, right? And again, some of this is review, but I want to make sure it sinks in, right? Exact price and the cost and the holding. So I can show you, and I'm going to show you some ETFs. You know exactly what the ETF owns at this particular point in time. You know what the price is. And it's very liquid that you can buy or sell it at any time because aside from regular everyday individuals buying and sell it, market makers are there. There's designated market makers to ensure that the value, the net asset value of the ETF stays in line with the real value of the stocks. And again, they provide immediate exposure to any basket of group securities for instant diversification. It could be all passive strategy or aggressive strategy, as I'll show you, right? They're flexible. You can use limit and stop orders, and they're very cost effective, especially the ones I'm going to show you as the core. Their expense ratios are less. Most of them are less than 0.1% now. And one of the biggest things too people forget about is the tax efficiency, which is huge. So the creation and redemption process avoids selling the actual fund holdings, so it limits capital gains. Once again, you invest in SPY or a similar ETF, you do not pay taxes on the rebalancing of it. You only pay tax when you sell it and from the dividends that you receive. So that's a huge edge. All right. So now, and again, why do professionals use ETFs? One is they might want to outperform other investments to express a view. They might want to manage risk. You can diversify. It's transparent. It's cost effective, and it's tax efficient. All right. And we're going to start with some of the core ones, which I'm going to show you. And we're going to look at first the passive ETFs. And what they do is they're basically believe in the efficient market hypothesis. They say, look, it's too hard to try to beat the market. We're just going to go with the market. We're happy if the market can keep giving us 10 or 11% per year. We're happy with that. All right. And what they do is they match. So for example, when SPY was created, they simply matched the S&P 500 as closely as possible. They looked at all the stocks, the 500 stocks, and they would weight it exactly the same as the S&P 500. All right. And so let's take a look at SPY first. And I'm going to show you. Actually, let me scroll down to it first here. Okay. Okay, I'll move this over here. Okay, assuming you can all see my screen. So SPY was really the first big stock ETF, and it was incredibly, incredibly successful. And it allowed individual investors to, with one click of the button, okay, it's like buying one stock. You buy literally SPY, and it trades like a stock. I'll just show you the quote right now. It's trading right now. This is a Bloomberg quote. Okay, so if you want to buy SPY right now, okay, you have an ask and a bid. Notice it's less than 1 cent spread. It's 1/10. I'm sorry, it's 1 penny spread. So it's incredibly liquid. And what do you get when you buy it? Well, you buy SPY, you get all 500 stocks in the S&P 500 in the exact weight that is currently in the S&P 500. If Microsoft is right now the largest company, valued company in the world, so it has the largest weight. Apple's second, Nvidia is catching up right now, a close third, and then Amazon and so forth. So you get all of these companies, and what it does is it limits. It gives you very low individual stock risk. You still have market risk or systemic risk. If the whole market sells off, you're going to lose money, but you don't have to worry too much about individual stock risk. All right, now, this is obviously a good one, and it's the most popular ETF right now in the world. If we look at a screen for the largest ETFs, SPY is still the largest, but if we looked at this 5 years ago, it would have dwarfed all the other ones. Now we notice we've got IVV and VOO that are actually catching up. And if we looked at the fund flows, we'll see that a lot more money is going into IVV and VOO. And I bring this to your attention because this is the first idea I'm going to give you. If you're looking for a simple strategy to invest in the US market, right, you could buy SPY, but you might even be slightly better buying IVV or VOO, and I'll show you why. If we look at IVV, okay, it does the exact same thing SPY does, but its expense ratio, as low as SPY's, is even lower. So its expense ratio, instead of being 0.95 or $95 a year for every $100,000 you invest, this is only 30. You're paying $30 a year for every 100,000. So it's the same thing with even lower expense ratio, which can add up a little bit in the long run. So what's happening is a lot of new investors now, instead of going in SPY, they're going in IVV or VOO, which is also the same really low expense ratio. You know, Vanguard has to compete and always be one of the lowest with iShares. So also 0.03 expense ratio. All right, now, is there risk? So if we buy this, right, we could simply buy this and be done with it. Now we have our investment in stocks, all right? So is there other alternatives? All right, let's think about it. So the one thing, though, when you're buying this, and this especially in recent years, there's been a trend. And what's been happening is the largest stocks have been growing the fastest in market cap. And in part, this is caused by the growth of ETFs. ETFs have grown. Just to give you an idea, in 2008, there was around, I think, 600 billion invested in ETFs. And now we're above 4 trillion. And now, when you have so much money going into, say, SPY or VOO, right, what happens? All the money going in, they have to buy 7.1% of Microsoft and 6.1% of Apple, et cetera. They don't buy Microsoft or Apple or Nvidia or Amazon, any of these companies, because they like it or they think it's undervalued. They buy it because they just want to mirror the market. And so what's been happening is funds like SPY have almost become somewhat momentum driven, where the biggest stocks are getting the most money, driving those stocks up even more. And in our history, this is where the top 5, you've heard of the Magnificent Seven. Magnificent Seven composed the highest percentage of the S&P 500 in market cap than ever in the history. And so what if you want, now there's 2 things that can happen. It can keep going as money comes in. The Magnificent Seven can keep growing, right, and widening their wedge, or we could have a reversion of the mean, and where the Magnificent Seven falls back. So other alternatives, and I'm going to give you a couple. So these are market cap weighted. Another really good ETF, and this is one where I have a lot of my core holdings in, is VTI. And VTI is also market cap weighted, but instead of holding just 500 stocks, okay, it has 3,500 stocks. So what does that mean? VTI is going to give you a little bit more stock diversification, right? And it's going to give you a little more exposure to the small and mid cap stocks. So if you look at the holdings, whereas in the S&P 500, Microsoft is over 7%, the largest holding of it. Okay, Microsoft's only 6.2%, and Apple's 5.4%. So it's not a big change. It's not a big change, but it's a little bit of a change where you're going to get a little more exposure. And the expense ratio is also low at 0.03. So personally, if I had a choice, you know, they're all great funds. I personally like VTI because I'm getting some exposure to 3,500 stocks rather than 500 stocks, and a little bit more of a small to middle cap weight. All right, now I want to show you a couple of other slides, and then we're going to do another polling question. All right. All right. So when I believe the way ETFs should be used is to implement a core strategy where ETFs are in the center of your strategy. And then on the outside, you can have other like active strategies, try to get extra income or whatever you might be. And you can have more than one. So for example, in the core might be SPY or VOO or IVV or VTI, which is my core one, right? And you can have some other strategies, which we'll talk about. So let me just go into this. All right. And you can also use it outside your portfolio. If you have a portfolio, you can use ETFs to customize your portfolio. If you have a portfolio, you're heavily weighted or you're underweight tech, we can look at ETFs that are heavily weighted in tech, which I'll go over in a moment too. All right, so you have a lot of different choices. All right, so Kieran, let's do the next poll, okay? The next thing I'm going to get into is you have a choice on ETFs. You can invest in market cap weighted ETFs that I showed, or we can look at equal weighted ETFs where every stock has the same weight. And I want to see what you think is better, which is less risky. All right, so it looks like it's a pretty mix, which it should be, and most of the predominant, a little more value weighted, was a little higher than equal weighted, and the answer is really about the same, but there's nuances in it because there's different risk profiles, and so let me go over that and explain the difference. Okay, so let me just show you an example of an equally weighted one, and move this out of the way. Okay, all right. Okay. So RSP is the largest equally weighted ETF in the world, all right? And if we look at it and we look at the holdings, you'll notice that the largest holding, these are all S&P 500 stocks, all the holdings are very close. They drift a little bit. It's basically 0.25%. So what does this mean? You now have absolutely no individual stock risk. So as far as the diversification benefits and the individual stock risk benefits, clearly an equal weight portfolio is less risky, right? We can all agree on that, all right? However, you're also getting more exposure to small cap stocks, right? And since we know that small cap stocks are more volatile than large cap, you're going to have more volatility. So that's why it's about the same. It's interesting. You have two contradictory types of risk here. And do you want to minimize individual stock risk? Then we would go with an equal weight portfolio. Or do we want to worry more about small cap risk? And determining which performs better. And let's compare them and see which has performed better, by the way, too. Okay, it'll be interesting. So I'm going to compare RSP, and I'm also going to show you the beta for the risk. Okay, so I'm going to compare RSP versus SPY. Okay, we're going to do different time frames. So over the last 5 years, you'll notice that SPY has outperformed. All right, and that is because of what I talked about. We've had this flight towards large cap where the big have gotten bigger, the rich have gotten richer, right? Microsoft's gotten bigger, it's grown. NVIDIA has grown amazingly. Apple had been doing really well up until this year. But overall, the large cap have grown more than the small cap. Now, is this normal or is this an aberration? That's the question. So if we look at things in historical context, okay, and if you look at Farmer French studies and everything else, where they looked at small minus large, you'll note that historically, small caps are going to outperform large caps. And it makes sense. Small caps are riskier, therefore investors demand some type of risk premium to invest in small caps. So whereas the last 5 years, large cap has outperformed small cap, let's go back. I think we can go back to about 2003 is when the RSP first came in to being.
One more zero.
There we go, I got it. Yeah, this is about as far back as we can go. All right. Yeah, so 2003. And now if we look at it, interestingly enough, the equal weight in the very long run has actually outperformed, whereas the S was catching up. So if we have the mindset that we expect in the very long run, and investing in these kind of things, very long run, that we expect, despite this 5-year aberration, we expect smaller stocks outperform large cap, then it might be a good idea to invest at least some of your assets in an equal weight fund like RSP instead of SPY. And there's one other risk that we need to understand too. Like right now, because these companies have become so big and powerful, and there's probably not the political will, because these giant companies also have very heavy donations to both Democrats and Republicans to protect their interests. But right now, there's some really big lawsuits going on against Apple for anti-monopolistic, what's the word? Anti-monopolistic practices. Amazon. So there's a lot going on. Now, if somehow the political will does, go after these companies, right, that could have a big effect. Whereas if you buy an equal weight, you don't care what happens to Apple because you've got 499 other companies that have the same weight, right? Whereas Apple being over 6%, it could put a little dent in SPY. So again, which one to invest in? It depends on what you think will happen. Small caps are by nature riskier. If the economy goes down a lot, there'll be more, more of the small companies will go out of business. We know Apple and Microsoft and NVIDIA are not going out of business in the next 10 or 20 years, right? So these are just different considerations. And so one thing you could even do in your core portfolio is to invest you can buy a big ETF like a VTI or SPY and have some of it in RSP. That way you get a little bit more exposure into the small and mid cap funds. So again, these are different things. All right. Now, what else can we invest in? So I'll tell you one of the things that I did. So about 15 years ago, when the market had gotten hit a lot after 2008, 2009, and I was looking at what sectors are likely to outperform the most. And so I figured, technology is growing. I want to invest in technology. But I didn't know which specific technology stock was going to do well. I didn't know, in hindsight, that Google was going to, grow 1,000 times from 15 years ago, as become the dominant, company in search. And I didn't know that NVIDIA was going to become, the dominant chip maker, et cetera, right? I didn't know Apple was going to keep on with all these inventions to keep growing, et cetera. I didn't know Tesla, back in 2009, we didn't know if Tesla would survive, right? So at least I didn't know that ahead of time. But what I did know, at least what I thought, was that if I bought all of these companies, right, like the whole tech industry, so to speak, I'm likely to get at least a few of these companies that are likely to go up 1,000 times or something. So let me just show you something. So I'm going to show you a command and talk about the asymmetry of returns and why another reason to potentially use ETFs or something. Okay. So if we look at what I'm going to do is I'm going to show you the best and worst performers, and I'm going to go back in time. Okay, this is just this year. Hey, there's Supermicro and NVIDIA. But let's go back. This is just year to date. So I am going to customize the period, and I'm going to go back 15 years. So let's go back to 2009. This is about when I was looking at these things. It'll load in a second. And so think about it, if you'd invest, let's say you invest, let's say you inherited $100,000 and you put $10,000 into NVIDIA and you put the other 90,000, 10,000 equal into the worst performing stocks here. So you only pick one good stock out of 10, right? What kind of return? Would you still be happy with your return? Right? Now think about this. If you picked only one good stock and it happened to be NVIDIA, or Tesla, or Broadcom, or Supermicro even, right? It'll get a little lower, but still, right? The answer is yes, you would be happy because even though the other companies, even if they went to zero, you would have made so much money on NVIDIA that it would have skewed your overall average return much higher than the markets. And so when you look at the overall market return, you know, about 11% say over a year over the last 50 to 70 years, the average stock does not go up 11%. The average and the median stocks probably go up more like 2 or 3%, right? Almost half stocks don't actually underperform, right? But it's the asymmetry of returns. It's capturing those companies that go up 1,000. NVIDIA is up 20,000% in 15 years. Tesla's up almost 15,000%. Netflix over almost 7,500%. So those are the companies that can give you this boost of return. And now it's very hard. We don't know. In hindsight, it's easy to have picked NVIDIA or Tesla, right? But we don't know what's in the next 15 years, right? I don't know that NVIDIA is going to keep growing. It can't. Once companies get so big, their growth rate has to slow. They can't subsume the whole GDP of the US, right? So one thing we could do, though, is if we buy an index, and let's say we think technology is the index, we'll find by buying the whole technology index, we're likely to find those. So that was my rationale for buying VGT. Let me just show you an example. So VGT, which is a Vanguard Information Technology Index, okay? And if we look at the performance of VGT, this is one of another one of my core holdings. And if I combine this and I compare it with, say, SPY, you'll see this is one of the funds that have, you know, pretty much consistently outperformed the market. Again, this is not an active fund. This is a passive but technology. So what I'm doing is I'm combining the passivity of just investing in this, in all the information technology stocks, weighted market cap, but picking a sector that I like. And so the Vanguard Technology Index is in white, and you know, you can see the average annual return over the last 15 years is over 21%. The S&P 500 last 15 years up over 14%. Again, great performance. So these are the kind of things that you can do, right? You can kind of try to boost your return. Now, I don't have, you know, so VGT, and who knows, maybe there'll be another industry or sector that might perform well. All right, Kieran, let's do our next polling question about which fund has been the best performer over the last, say, 10 or 5 years. I have a couple of those questions.
Which one should I pick, 10 or 5 years?
You know, do 5 years first. And what I've done here is I've given you the ticker symbol for it, and then I've given you the description of it to make it easy for you to kind of pick it, right? This is just over the last 5 years. Okay, so it looks like the voting's pretty much done. Okay, so most people pick VGT. And VGT is a great choice. It was an amazing return. But if you look at the top one, you'll notice where it says leveraged semiconductor index. And I just want to start giving you a couple of other things. So USD has been the best performer over the last 5 years. Now, I'm not encouraging anyone to buy it unless you're a bit of a gambler. But the reason it's been the best performer is because you can also, whenever you see pro shares, they're usually leveraged ETFs. So what this ETF does is it actually invests, in this case, the semiconductor index, which has been one of the best. Semiconductors, like a part of the information technology sector, has done the best. And they borrowed money so that they can invest twice the amount in the semiconductor index. So this has been the best performer of the last 5 years. And again, if I look at the comp here, and I compare this to, say, VGT, and I'll compare it to, say, SPY, so you can kind of see. And I've got the last 5 years. So this semiconductor has averaged 52% a year over the last 5 years. I mean, so again, I'm just showing this to you. I'm not encouraging anyone to buy this now. It's up so much, but you can use leverage. So there's all kinds of ETFs, right? You can be very passive, and I encourage you, the basic strategy of things like I mentioned, whether it's SPY or VOO or IVV or VGT, one of my favorites, right? Or an equal weighted one like RSP, okay? Or you can pick a certain sector if you believe in technology, VGT. There's banking ETFs if you want to get the financial sector. You can invest in gold. You can invest in just about anything, all right? And another thing you can do is you could use inverse. So this is leverage. I showed you a leverage ETF, but we can also use inverse ETF. So let's say, and by the way, what is gambling? Let's say you're a gambler, right? You want to bet against the market, or you think the market's overbought. Like certainly in 2008, you could have made a lot of money, or in 2020 with COVID, or maybe at the outbreak of the Russia-Ukraine war, the market got hit hard. So if you could time it and get out of it, you could make money. But in the long run, it's very hard because it's like going against the wind, up a hill. Because if the market goes up on average 11% a year and you're shorting it, it's very tough. But one area it can be useful is hedging. So if you're a fund manager or you're just long a lot and you don't want to sell stocks to take tax gains, like for example, I own a lot of VGT from 15 years ago. One of the reasons I'm not selling it is because if I sell it, I have a huge tax gain that I have to declare. So one thing, if I thought, I'm not giving you my opinion, but if I thought maybe VGT's gotten ahead of itself and maybe it's due for correction, I could, buy an ETF that's short. Like, I'll just give you an example. And they have short. You can bet against any company, NVIDIA, but SH is the largest short one. So it's, again, ProShares short. And so what this does, notice it's up today because the market's down. So this moves totally inversely to the S&P 500. And so obviously this is done really abysmally, and you would have lost most of your money in the last 5 years because you're betting against the market. But it just gives you a hedging capacity to hedge. So with that said, I think I'm ready to open it up to questions, so you can kind of ask me anything you're interested in. I can show you.
And if you want to just, there are two ways in which we can do this. One is if you can type out your questions in the chat room. And if you want to just ask questions verbally, just raise your hand and I'll give you permission to talk. Any questions?
Let me ask one thing for the audience. This will be fun. This is a fun question. I hope I don't. I always try to be politically neutral, but let's do it. Let's do a fun thing. Do you know also that you can actually, they have ETFs that follow politicians and what they buy and sell. So I don't know if you know, but there's been some controversy, or depending how you look at it, what your party is, about Nancy Pelosi. And so Nancy Pelosi has actually been an amazing investor. There's a fund, NANC, and there's another fund called KRUZ, simulating Ted Cruz. So let's poll of who they think's going to make more money, the Democrats or the Republicans, say in the last their ETFs.
Oh, I didn't put. Give me 1 minute. I didn't
Sure.
put the choices. I thought I did. Give me 1 minute, okay?
Sure.
Oh shoot! I launched it. I can go back. The first choice one is Democrat. Choice 2 is Republican.
There we go. Okay.
Choice 1 is Democrat. Choice 2 is Republican.
Pretty close. That's good. It's almost like the upcoming election, right? Biden versus Trump, or it's pretty 50-50 here. Looks like okay. So it looks like 16 versus 15 voted for that Republican ETF did better. So no, the Democrat ETF did better. Let me just show you significantly. So NANC it's called Unusual Rare Subversive. Let me just give a description, then I'll show you the Republican one. Okay. Okay, it's an ETF in the US, subversive democratic trading, actively manage, achieve investing in equity securities of companies that sitting Democratic members of the US Congress and or their spouses have reported to have invested through public disclosure filings. Right. And we can actually look at the holdings, and I believe NVIDIA is probably the biggest holding here, is one of the reasons it's done so well. Yep, NVIDIA is the biggest one, then Microsoft. So, does this mean also that when voting comes, it's unlikely that there's going to be some big ruling against NVIDIA or Microsoft? We'll see. Alphabet, Amazon, Apple, okay, it would be interesting, all right? And then we can look at KRUC. Okay, again, unusual where subversive Republican trading. And we can look at the holdings here. Conoco. So interesting, right? Oil companies, right? But they do that interesting. Amazon's got protection both ways. Right? NVIDIA too, but only 1.9% in NVIDIA for the Democrats were 10%. So that's interesting, right? But more oil companies, Chevron, etc. So, and now let's look at we can compare it. So if we look at comparative returns, Cruise and AMC, and I'll leave the SPY up there too, just so you can see how they've done versus the benchmark index. And let's go 5 years. I think it's about as far back. It's pretty new. Actually, I don't even think it goes 5 years. Try 2 years. All right, so it goes back from February of 2023. So if we look at it, the Democratic has averaged 28%, and the Republican one has averaged 15%. So the Democrats won a lot. Now, I'm not getting into politics, but I'm assuming now the Republicans can say, well, the Democrats must have had inside information and cheated, and the Democrats will say something about them being smarter. So whichever, we can even make this a whole fun political discourse, but I'm not going to go there. I'm staying politically neutral, but I think it's more humorous than anything, of course.
Andrew, there are a bunch of questions.
Yes, great. I'm ready.
And I think this is we're going to have a nice discussion, I think. If you go to Q&As, is it possible to lower diversification of the entire portfolio having multiple ETFs? Like
Yes,
are you really diversified well if you own VOO and VTI?
Okay, so that's a great question. So you are very diversified if you just own VOO or VTI, because in VTI, your largest one stock is a little over 6%, and it's a company, Microsoft, because it's so big and solid, it's not going to be as volatile as a smaller company. However, I agree that you can get more diversification by, for example, if you combine, say, VTI or VOO or any of the other market cap ones, and the reason VTI is a little more diversified because it's 3,500 stocks, right? With, say, RSP, where you get some equal weight, I think the two combinations are really good. And then you can also consider an international fund. There's ETFs like VXUS is a Vanguard International Index. I will say that international funds have significantly underperformed their US counterparts. And, I joke that, and I always when I talk to a lot of these advisors like at Vanguard, they always encourage me to invest more international funds, because if you look at the metrics, the stocks are much, much cheaper. But I think they predicted 10 of the last 0 international outperformance years. They keep saying internationals due to outperform. Eventually it'll happen, but it hasn't happened yet. But anyway, but all joking aside, you can also get some little extra diversification with some international. So I guess if you get, 3 funds, maybe have your big core one in like a VTI, your second biggest position in an RSP, or maybe even RSP just as big as VTI, and then maybe a small, maybe 10% into something like VXUS or some other international fund. You are really, really diversified in that, so.
Andrew, there's Kim is asking, apart from leverage, what could be other reasons for the leverage index on semiconductor outperformed other indices?
Well, sure. So leverage, look, it's taking advantage of the quest for gambling. Look, when someone creates an ETF, it's marketing, right? They want to get as many people investing in their ETF as possible. So the people that invested in the leverage one are people that are probably younger investors who really want, they're confident. Look, if they've invested in that, they've been right, right? Now, will they be right in the long run? I don't know. But that's the leverage ones give you more bang for buck, so they can gamble more, right? I mean, that's the main reason for it, to try to maximize your profits.
Another question, does it matter if I use Merrill or Schwab or any other company when purchasing stocks, etc.? Is one better than another?
Not really. They're all, as long as it's a big reputable firm, they're all pretty similar. They all have right now very low transaction costs. So yeah, and they all have ETFs. And you could buy, for example, you can buy a Vanguard or a State Street ETF through any of those companies. So it really doesn't matter much. They're all good.
Another question, do investment groups utilize ETFs for short-term gains versus the typical long-term gains, especially with fluctuating markets due to international politics?
Yeah, so for example, if I were to invest internationally in international politics, take China, for example, right? I mean, you never know when China's gonna, not when Xi, right, is not gonna like one of the CEOs, right? So, I mean, Ma, who was, from Alibaba, was, chastised, and his company got hurt. So anyway, the point I'm making is to reduce that political risk from a particular country, an ETF in China is the way to go, because by having big diversification, you don't know which company is going to be the big success story. But if you believe, let's say you think China is going to eventually grow and do well, or India, or any country that you like, you can invest in kind of that whole group of stocks, so you're more likely to not miss out on the real outperformance, just like I mentioned with using VGT as an example. So that's why I think ETFs are great. And then they're tax efficient, so you have less taxes in that. And then as far as even active fund managers use ETFs, they might have certain stocks they like, and they might have extra money, and they might want to park it in a sector. Look, I run a fund, so I have my own money. I have a lot of my money in ETFs, and then I have my active strategy outside the ETFs. So I try to mix in and try to get some outperformance there.
Andrew, at what point is it good to enter the market with an ETF?
Okay, well, okay. So now by the way, I don't purport to be able to time the market well at all. I mean, right, and the market's had a big run. Historically, when the market's had a really big run and things have gotten high, usually, like I'm talking decade, the next decade usually is a little bit lower return. We have some reversion to the mean, just like a terrible decade is usually followed by a good decade. But having said that, and what are your alternatives? If you're looking to invest in bonds or cash, in the long run, the stock market's been a great place to invest. Now, one safe way to invest in ETFs is dollar cost averaging. So one idea is, if you're, especially those of you that are young, that have your high income years ahead of you, by putting a set amount aside into a retirement account every 2 weeks, paycheck or month, you have the best of everything. Because think about it. If the market keeps going up, you're great. You're starting to invest and build capital. If the market has a big sell-off, you don't even care much, because your human capital, your future earnings years are going to be higher going forward. You'll be able to put more money when the market's down. And this way, you're going to average into an ETF, the market, et cetera, at a good, in a good way. And so just briefly, dollar cost averaging, by putting the same amount of money into a fund, right, at set intervals, when the fund price is lower, you end up buying more shares with the same money, so you lower your average cost. When the fund price is higher, because you're putting the same money and you're buying less shares, so if you average those out, your average cost will be lower than if you just bought the same amount of shares every time. I hope that was clear.
Andrew, there are a lot of good questions here.
Okay,
one simple one is, what's the program you're using?
I'm using Bloomberg, right? I was showing you on Bloomberg.
Yeah.
But they all have it. You can go on Vanguard, you can just go on the internet and look up ETFs, and everything I'm showing you on Bloomberg is available on the internet.
ETFs are great for safe long-term investments. What would you recommend for someone in early 60s and a short timeline?
So I still recommend ETFs, because hopefully, look, we're living longer and longer. I hope you don't have a short timeline in your early 60s. I hope you have at least through your 80s, maybe 90s. one thing you could do, there are ETFs that pay higher dividends. Let's see, I think it's SCHD, if I remember. Yeah. So here's an example of one. So the Schwab high dividend one. So this is an ETF that I would say would be better for someone in their 60s because it pays a higher dividend yield. It's more likely to be safer and you know, have a lower beta. So if I look at the beta, for example, and I'll compare it with the SPY. Yeah, so its beta is less than 1. So for example, this shows me that this is an ETF, and I'll go 5 years, that seems a little bit safer and it gives you a higher dividend yield. So that's just one example. But again, you can also wait a minute, if you're, as you get older, you can start putting a little more money into bonds. And there's bond ETFs, you know, there's BND, which is Vanguard's big total bond index, which is spread out over maturities. And you know, that's going to have low volatility, although you won't get as high a long-term return. So you could start, as you get older, you know, you should shift some of your assets into safer things like bonds, and there's plenty of bond ETFs out there.
Great. Many good questions here. Would you recommend replacing your index funds with ETFs in your portfolio?
Yeah, so I've been doing that. I've been myself switching them into ETFs, and a lot of, I think in my Vanguard, I think they're automatically doing it for me in a lot of them. There's again now there's not a big difference, by the way. The big thing is to make sure the tax efficiency. So, and you're able to trade ETFs, you know, in the day. So yes, I would encourage you to switch your index funds into ETFs. I don't see any downside. Just make sure the expense ratio is not higher than it should be. In other words, look at this expense ratio, right? This one's 0.03. This is Vanguard. So make sure that your expense ratio is low enough. And sometimes they'll give you a lower expense ratio if you invest more in one asset. Like I know at Vanguard, the more money I have in there, I become what's called an admiral client. And so the expense ratio is lower for me than if I had less money. So take advantage of those breakpoints.
How are Bitcoin ETFs doing?
Oh, well, Bitcoin has been phenomenal. Obviously, that's been one of the best performing things. So if we look at Bitcoin, right, it's been one of the best performers this year. It's more than doubled this year. But again, past return is no guarantee of future return. And you know, I'm the first to admit that. I mean, Bitcoin's driven by supply and demand, and if more people put that and put some of their invest in ETFs, put it in their portfolio, it's supply and demand is going to grow. But I just want to be clear, Bitcoin has no intrinsic value, really. It's really not much of a use value. Its value is the supply and demand, which people like to have it, especially the younger generation. And that higher demand with limited supply is causing the price to go up. But I have no idea if Bitcoin's going to be up to 200,000 at the end of the year or back down to 20,000. Again, I have no idea. Okay.
These are a couple of a little more specific questions, more technical, sure. I would think. Do you have any opinion about active funds that also utilize derivative strategies, such as synthetic covered calls puts to generate income? For example, NVDY.
NVDY, okay. Next up, okay, good. So let me explain a little bit without losing the audience and keep it simple about option strategy, okay. So when you start using options, but options can be a good tool. Here's the problem with options as far as the investor, right? Option spreads are wider than stock spreads. So every time you do or the fund does an option trade, they lose a little bit of money. I'll give you an example. If you look at, and let's just look at NVIDIA, for example, options. So I'll give you an example. So if I were to go, just go OVNB. All right. So let's say this is the strategy you're talking about. So basically, you go long NVIDIA, and then what you do is you sell it, you do a covered call. So I'm going to show you this in a simple way. So I'm going to sell a call. I'm going to buy the stock. Okay, let's say I bought NVIDIA here, and let's say I sold the call at 870. expiring in July. Okay. All right. Now, the scenario looks okay because what's going to happen, what I've done is I have, excuse me, I have increased, let me just show you by July. Okay. What I've done is I've sold a call and taken it in premium, which makes my break even higher. So by buying NVIDIA, these calls are pretty expensive. So NVIDIA is a good example. Basically, I can make money as long as NVIDIA stays above 800, let's see, actually lower, $782, right? But I lose the big upside. So if I do that and NVIDIA goes up to 1,000, I only make what I sold the call at. So it does decrease risk. It captures some return. But let me just show you what happens in the real world. Because I used to trade options, I've been a market maker. And if you look at the spreads in NVIDIA calls or puts or anything, it's a wider spread. And NVIDIA is tighter than most. But my worry is, so for example, instead of it being a penny spread, it's about 40 or 50 cent spread. So every time you do a trade, you lose that little slippage. And my fear is with NVIDIA being a really, liquid stock, let's see if I go a little less like Broadcom, BROAD. I don't want to take too much time on this ABGO. You'll find it's a little wider. So here, that's like a $3 spread, $2 spread. The point is, I think you're giving up a lot of return. I don't think you need to do that. I think in the long run, you'd be better off buying the straight ETFs. I think those esoteric ones sound good, but in the long run, you're going to end up not doing as well with those. That's the short answer.
We are running short of time. We have
Sorry.
a couple of minutes remaining. I see more questions here, but I'm going to ask the question. Somebody I recognize from ODU. You can always meet Andrew. One question is, could you touch on thematic investing and the potential of it?
Sure. So, and just so everyone knows, so thematic investing is investing in something that's like a theme of something. Like, for example, AI, right? AI is the hot topic right now. So there's an ETF, AIEQ. And again, it's great marketing, right? Who wouldn't want to invest in an ETF that invests in AI, right? Seems like the new thing, so it's got to be a winner. A lot of the thematic ones end up losing money. What happens is they're great marketers, they get a big demand, and so the stock, the ETF trades at a high level, and then it ends up not doing as well. The cannabis ETFs were examples, so I would be wary of them. I mean, certainly, the AI one seemed like it would be good, but its performance hasn't been nearly as good as like a steady one like VGT. So if you compare AIEQ, for example, which seemed like it would be a good one, average annual return over the last 5 years, 6.7%, right? And there's also, by the way, ESG. Another thing you do, there's ESG ETFs. So you can invest in sustainable ones like ESG. I think it's ESGU. Yeah, there it is. ESGU and ESG. So here's a sustainable ETF, right? That looks for companies that have high ESG scores. All right, and you feel good. But I've looked at some of these. Some of these don't always have all. I'll show you an example. Let's see. Oh, this one's all right. I mean, one of them I saw had Coca-Cola as a big holding. And whereas Coca-Cola might do great with recycling, me personally being a health fanatic, I don't think Coca-Cola is good for society, making billions of dollars on sugar, water, and chemicals, but that's just me. But anyway, sorry, continue.
Andrew, I know we are at 1 o'clock, but just one last question, if you don't mind.
Sure.
Would you mind speaking briefly about the use of ETFs for loss harvesting?
I'm sorry, say that again?
Would you mind speaking briefly about the use of ETFs for loss harvesting?
Oh, loss harvesting. Okay, sure. So, well, just like a stock. So if you bought an ETF and you're losing money in it, you could sell it and take a loss. So just like a stock, it's the same thing as a stock, right? When I say ETFs are tax efficient, means that when the ETF itself rebalances, you have no tax consequence. But buying and selling it is the same as buying and selling a stock, right? You buy Apple and you hold it for 30 years, you don't pay any taxes on the gain until you sell it. Same thing with an ETF. And just like if you buy a company that goes down, you could sell it, and then you could buy another ETF. So a good strategy might be you buy an ETF, you like it, but it goes down. You sell it, take the tax pay, and then you buy a very similar ETF. So now you still have the same exposure, and you've taken your tax loss, so it helps your taxes. Hopefully that clearly explains it.
Excellent. That was awesome. Great questions, participants. I think, a lot of things for us to think about. Andrew, thanks so much again for doing this. Maybe we'll follow it up with some other, investment related webinars in future semesters. But
Yeah, I'd be
thanks so
happy
much
to do-
again.
Yeah,
Yeah.
it'd be my pleasure. We could look more active, like how to try to beat the market. Now I've shown you how to follow the market. Now we can look at how to beat the market next.
Yeah. Wonderful. Thanks everyone for participating, and look forward to having you guys again in the future. Have a
Thank you.
nice day.